Tell me about a look-back strategy. It really doesn't require amending tax returns, if I'm understanding all that correctly.
It's a beautiful thing. What you're referring to is called, we use Form 3115, which is a change in accounting method. This means that rather than redoing the tax returns, let's just say you've been doing straight line depreciation for the past 5 years, and then you're like, oh, I just learned about cost segregation. I want to do a cost segregation study. Well, you can do it in the current year without going back and amending prior 5 years' returns. You can do all this and capture that missed depreciation. We help you calculate the difference of what you actually took on your depreciation schedule versus what you could have taken. And that difference is called the 481 adjustment, and it goes on Form 3115. It's a very complex form. Highly recommend either working with us or a CPA firm who really knows how to fill that out, because you want to do it the correct way. It's an automatic change. Switching from straight line depreciation to accelerated depreciation is an automatic change, and the IRS allows you to take this difference on the current year and capture all that. I said there's multiple ways to take advantage of these depreciation losses, but like if you didn't need them in prior years, then now you need it this year. So you can catch up on it now and take all those losses in the current year. Or if you weren't a real estate professional in the past, but you're a real estate professional now, okay, you can take those losses now and they count as active losses, and you can use them to offset all kinds of things in the current year through real estate professional status. There's some interesting things there.
How are renovations and CapEx opportunities often overlooked through this scenario?
I explain it like this. When you are depreciating property, it's based on a depreciation schedule based on your in-service date. Let's say you buy a property, fix it up, you put all these capital expenditures into it, and then you rent it out. Well, we can include all of that CapEx in the cost segregation study because it's all getting placed into service on the same date. So you buy a property in January, you fix it up, you rehab it, and then you're ready to rent it out, and you place it all in service in April. We can include what you bought in January plus all the rehab from January through April, put it all in one basis and put it into the cost segregation study. And then you start depreciating it on your in-service date. It's really when you either start renting it out or it's basically available for rent and you're trying to rent it out. And so all that gets included. Anything that's done afterwards is going to be minimal enough where your CPA can just depreciate it and you don't need a full cost segregation study done, and it's pretty straightforward. Or let's just say it's 6 figures of rehab, you spend another couple $100,000 on the property. Afterwards, we can do another study, like an ancillary cost segregation study for that work too.